market risk is anytime you buy a stock, your stock could go up, down, up and down and sideways. You are taking market risk. It's a fact of life. You don't like market risk, buy T-bills. It's as simple as that. Now, it's a fact of life, it's unavoidable. So what is it? What is the investment risk that I avoid? So market risk I coexist with. Well, what is this investment risk that I strive to avoid? Investment risk is what I would expose myself to in terms of adverse developments at the company that I buy because of factors internal or external to the business. Basically, it is anything internal or external to the company that could permanently damage the value of the business that you bought. It could be, I mean, the internal factors, very generic internal factors could be a poor balance sheet. You know, poor balance sheets expose you to a lot of risk. And anytime you buy a company with a poor balance sheet, you are effectively, de facto, taking on some very serious investment risk. What if the company cannot refinance? People have always assumed companies can refinance. Well, you have seen that happen again and again, yet again and again, where companies had difficulties refinancing and then go bust. Bad management, well, right there. People doing stupid things with your money is not something you want to do. You know, they could be dishonest, they could be stupid, you want to have neither. So think about what these people have done over the many years in the past. Separate promotional management from sort of nose to the grindstone, serious, hard-working people. Third risk internal to a company can be a bad business model. Let me give you an example of a bad business model, avoiding which has kept us out of so much trouble over the years. It's a model about, you know, when companies, because of their business, have to access capital markets or financial institutions again and again to keep their business moving forward. I'm not talking of companies that need to access capital markets in order to grow the business to make an acquisition, but ones that need to, for recurrent business needs, go to capital markets again and again. Now, examples of companies like that, which we obviously avoided, because it's a business model I'm very, very wary of, is businesses like the investment banks that had big capital markets operations. Witness Lehman Brothers, witness Bear Stearns. Both of them needed credit rating. Credit rating agencies one morning freak out. That's the end of those businesses. That's not the kind of business I want to own. Obviously, that's an imperfect means of eliminating businesses because this blunt instrument of eliminating a kind of business also eliminates the Goldman Sachs and the Morgan Stanleys, which have so far been very successful companies and still surviving companies. So there are some business models I'm very wary of. What about external factors? Factors external to a business that we are wary about, obviously, businesses, industries are very sensitive to government meddling. Now, government meddling is a wild card. You never know what that is. And anytime you invest in certain countries, you are probably taking on more business risk, more sort of government risk, regulatory risk than others. You know, investing in Russia comes with its own sort of issues. Although, let's not you know, take it out on Russia. Let's take it out on other countries, like New Zealand, for example. Innocent New Zealand, with the cleanest corporate governments, one of the cleanest governments in the world. Well, an example there was some years ago, we used to own a company called Telecom Corp of New Zealand. Fine company, bought it because we believed that its competitors would die, which is exactly what happened. It turned into a duopoly in the fixed line business, a duopoly in the wireless business. Company was doing brilliantly, had lots of excess cash, until, of course, the incumbent government in power, Helen Crook's government, let's name names here, decided, and you know, she was very unpopular, she decided, well, one of the ways I'm going to get my popularity back is let's beat up on Telecom Corp of New Zealand. The shareholders are foreigners, they don't vote in New Zealand. Let's break up Telecom Corp of New Zealand, and let us also make sure that New Zealand Telecom winds up giving farmers broadband access at the same rate they give people access in large major sectors. Obviously, utterly non-profit, in a highly unprofitable venture, but supposedly very popular. She thought it was going to be very popular. Now, imagine the impact of that on a company like Telecom Corp of New Zealand. So the business purpose was being bent to suit political ends. That does not work for people like us. As that news began to break, we sold. It was a profitable investment. And we, thank God, never had to look back at that. Of course, She was not re-elected. Her policy was so ridiculous in any event. But that's an example of a government policy change that can really blindside. Handicapping governments is not easy. Some governments is easier. Argentina, for example, is a very easy thing. Yeah, or for example, another sort of external risk that we worry about a lot is, and I alluded to that, is industry structure risk. You know, there's some industries I don't want to invest in. Industries which have, as I said, ease of entry, for example. Industries which have unusual competitive characteristics. Why bother? There's probably easier ways to make money.